Today we are joined by global economist Andrew Hunt of Andrew Hunt Economics, an independent firm based in the UK which provides macroeconomic analysis for select clients in both the financial and commercial sectors. Prior to founding Andrew Hunt Economics in 2001, Andrew spent over 12 years in Europe and Asia as a chief economist advising both the board and asset management divisions of the Dresdner Bank Group and the equity asset management division of the Allianz Group. Andrew was recently appointed as economic advisor to Clearway Capital Solutions and has worked with members of the Clearway Capital team since the late 1990s.
Hi Andrew, welcome to Turning Points once again. Really great to have you dialing in with us from your second home in New Zealand.
Great being down in this part of the world. The Northern Hemisphere is a bit fraught these days.
And also sort of off the back of that, I guess, it looks like markets have shrugged off all the adverse events of the first half of 2025. Why is investor sentiment, why is it remaining so resilient despite sort of the growing macro risks, especially around debt and tariffs and political uncertainty?
I mean, I think a lot of it really comes down to the big sort of bogeyman that we were all petrified of in February, that there would be a repatriation of foreign capital, that President Trump would say something that was so outrageous or so scary that markets would take fright, foreign investors would pull their money out, the yield curve would steepen sharply as treasuries sold off, and markets would do a version of the Asian financial crisis. And I mean, you and I worked together during the Asian financial crisis and can sort of, first-hand experience of how bad a repatriation trade can be. And we haven't had that. I mean, self-evidently we haven't had that, but the data is astounding that the US has attracted the fifth largest level of capital inflows relative to its GDP in history, certainly in modern history since we had economic data. That foreign investors have chased AI, they've chased private credit. There's been a real, I think, sense of FOMO for a lot of foreign investors that the US has been the only game to chase. But also there's other things going on. I mean, you said the Northern Hemisphere is a bit fraught, so we've got pretty massive capital flight from Asia at the moment. That's where geopolitics have exerted an impact. Places like Taiwan are seeing huge outflows of resident capital. People worry that the 7th Cavalry wouldn't come over the hill to rescue them in the event of some event with China, so they're taking money out. But at the same time, Chinese savers are diversifying out of China. They've got problems in the banking system there and the weak economy, and perhaps we'll talk a bit more about that later. But that's leading China to have about $1.5 trillion of capital outflow a year. And the irony is much of that money ends up in the US, maybe through offshore financial centers, but it's going there. And then in Europe, we've got two things that are driving money out. First one is the European Central Bank might not be doing an official quantitative easing, but it's doing what I call a stealth QE. It's lending a bit of money to the commercial banks, and the commercial banks are buying the bonds and exploiting the positively sloped curve there. But that still generates liquidity. It's kind of QE one step removed. So European investors have got some money to spend. They're attracted to the AI theme, etc., in the States. But also European governments are being a bit shifty about how much they're borrowing. They've pretty much suspended all data on their government borrowing requirements. We talk about data problems in the US, but nobody talks about it in Europe at the moment. And where European governments are borrowing to try and hide how much they're borrowing, I mean, the budget deficit's 7, 8, 9, 10% of GDP probably. To hide some of this, they're using a lot of off-balance sheet vehicles, defense funds, infrastructure funds, green funds, development funds. All it's like an alphabet soup of European debt issuance. And most of this stuff is illiquid. It's being sold to the European banks, who I guess will hold it to maturity. But because this stuff is almost non-marketable, it's illiquid, it's of no use to the big international banks and the insurers who've got their asset liability modeling to think about, who need long-term assets to match their liabilities. Because this stuff isn't liquid, it's of no use to them. And so they're really left with the choice of, there's a few JGBs. There's plenty of gilts, but nobody really seems to want those. There's some French government bonds, I guess you could buy, but they're under a cloud. So As somebody put it, treasuries end up as the least dirty shirt, or the best horse in the glue factory was another expression. But we're seeing these large capital inflows into the US. We haven't seen funding problems. Yields, if anything, have come down a bit, and the equity market is being driven by this foreign liquidity. And you can see it in the monetary data. It's a bit like 2006, that all of the liquidity growth that's supporting the markets is really now coming from the foreign sector. But this is a powerful force, and I think it's been right not to stand in the way of it. We thought liquidity conditions could tighten this year and had to sort of do a U-turn at March time when it was clear the easing in the rest of the world was powering US assets, and I think that'll continue for a bit.
All right, Andrew. So with US interest rates coming down, is that going to extend the cycle? What's happening with that?
I think it does extend it for a while, probably not for as long as people are currently expecting or discounting. I mean, I think pretty much everybody I talk to in the US is expecting the Fed funds to have a 1 in front of it within a year. Political pressure on the Fed, the sense the economy is a bit softer. I think it's mainly political pressure, to be honest. And that political pressure is partly, I think, because the administration just wants lower yields in front of the midterms. But there's another dynamic in the background. The debt burden in the US, if you look at public sector interest payments and the private sector's interest payments, that's now running at 2.5 times the rate of nominal GDP growth. And that's not something you see very often, and it's something that's emerged really since the borrowing binge of the pandemic. But the last time we saw significant economies facing that issue of debt compounding at twice the rate of incomes was Latin America in the 1970s, or other emerging markets when they got into trouble, Asia, early 90s and so on. So there's an absolute imperative to get yields down to avoid this debt trap, this compound interest. Great book written in 1988 by a guy called Professor Tim Congdon, called The Debt Trap, that kind of explains the mechanics of this. But essentially, when you get to these sort of ratios of interest expense to GDP growth, the debt ratios tend to become exponential, and at some point the system will break. And that's why I think there's so much pressure from Scott Bessent and others, and obviously the president included, to try and get yields down. And at the moment, equity markets are just looking at that and saying, well, that's great. Pavlovian response, lower yields means asset prices go up, credit growth accelerates. Now, I don't think that's necessarily the case. There's a lot of uncertainty in the US. It's not clear that lower interest rates will get people borrowing more, particularly in the economic environment. I mean, I think we've got a view, there's kind of almost an urban myth that the US is strong. And certainly the trillions of dollars being spent on AI are generating economic growth. But you strip AI out of the data and look at the rest of the economy, the 95% of the economy that isn't AI and that isn't the Mag 7. And you've got consumer spending growing at about a 0.7 annualized rate, which for the US is close to stall speed. Residential investment is down. Non-AI capex is down. Inventories and imports and exports are going up and down with news about tariffs. That's just creating a lot of noise. But most of the economy is actually quite soft. Household income growth in real terms is now down to 0, and potentially tariffs will make that go negative as the tariffs come into the consumer price index. So the administration wants lower rates for political reasons. It wants lower rates because they see some of this softness. Probably their donors are telling them this. And we need lower yields to prevent this debt trap dynamic. And so I think the Fed will capitulate, but that doesn't mean to say that the credit system will respond. I think, from my own client base, I get the sense that commercial banks are quite cautious. They're seeing defaults starting to rise, and they don't just fund directly. They've also been funding the private channels, private equity, private credit. There's a lot of hidden leverage in those. Private equity typically uses NAV loans. The big donors for NAV loans are small regional banks and some of the private credit institutions. Private credit runs 1, 2, sometimes 6 times geared, depending what it is. The marginal funding for that leverage comes from banks. And you're just getting the sense that the banking system is getting a little bit nervous about this. You're starting to get stories about perhaps a little bit of wrongdoing in the private credit universe. We've just had that auto parts company go bust, and it wasn't just that they went bust, it was some of the stuff they've been doing looks a bit questionable. The same collateral promised to lots of people. Perhaps some of the accounting might have been a little questionable. So there's this little bit of risk aversion. The sense the economy is not that strong. The defaults are starting to rise in the real economy. Some of the housing markets, regional housing markets, look a bit extended. So I think even if interest rates come down, we might not see another wave of domestic credit. So yes, as rates come down, I think we get a pop in markets. Risk assets, I think, will react to the news or react to the prospect of lower yields. But I suspect it'll be a relatively short-term rally. And the other question is what that does to the outlook for inflation. If we think of policy over the last 5 or 10 years, every time something's gone wrong, rates come down, and there's something QE-like, whether it's QE one step removed in the way the Europeans are doing it, or more overt with central banks doing yield curve control, or just buying bonds. And it's a bit, every time you pour money into the system, you're not changing anything real. You're just kind of fooling people by putting more money into the system in the hope that they will spend that, and you get some reaction in the real economy. Now, eventually people kind of learn this is happening and start to expect it. And one of the things that we're seeing globally, not just in the US, even in Europe, where there is virtually no inflation, and certainly in Japan, is household expectations of inflation are picking up. And the thing that worries me about central banks easing over the next few months is if they do it obviously, and it looks a bit of a panic, and it looks like we're trying to avoid a debt trap, and it's a bit political, and we're undermining the Federal Reserve, and it looks like in Europe policies driven by the French government's inability to pass a budget rather than what the ECB should be doing, that people will say, you know, they're just chucking this free money at me, and stuff that's free doesn't really have any value. So I'm going to change my own pricing behavior. I'm going to want higher wages. If I'm a company, I'm going to put up my prices, because I've seen this movie before. They threw money at us in the pandemic, then we got inflation. They threw money at the end of 2023 at us, and we had inflation in early 24. So, you know, I've learned what happens here. I'm going to start putting up my prices. And what we've seen, so pretty much across the world, is inflation expectations are proving sticky. In some cases, including the US, household expectations of inflation are starting to rise despite the soft economy. And I think all of this could start to question this liquidity-driven, maybe we should call it a bubble, certainly these liquidity-driven markets that we're seeing. As we get into next year, perhaps the credit system didn't respond as actively as the market's anticipating, but the household sector's starting to predict inflation, changing their behavior, and that 2026 we start to think about inflation coming back. And I think that's quite a valid hypothesis. So I've been sort of musing the hypothesis that if we do get a rally in markets as the Fed cuts rates and we have a bit more of this QE one step removed, enjoy the rally. But maybe that's the time to think about repositioning. Perhaps a little bit of value starts to creep into the equation. Certainly looking for some inflation hedges, whether that's in precious metals. Perhaps crypto has a little bit more support in that world. I don't think it's a great store of value, but there's a demand for it. There's a supply curve for it. So if demand goes up, we should get higher prices. So I think this next easing isn't going to be the magic thing that just keeps markets rallying. I think it could actually start to undermine the rally a little bit, because it undermines people's faith in money as a store of value. And when you start doing that, you're edging towards that 1970s dynamic. And I think a lot of people think of the 1970s as being inflation and being fairly sort of a decade of consistent inflation. Actually, there were two spikes. There was one in 73 with the oil shock, then it came down. The economies were soft, governments eased. In fact, they eased too much, and inflation came back at the end of the decade, largely because people were expecting it. And it was that second spike where inflation actually peaked at higher rates. And more importantly, that's when bonds actually sold off. They really much ignored the first inflation spike in 73, 74. It was the second one at the end of the decade that worried them. And I think we might be repeating some of that narrative, not just in terms of economics, but politics as well. And going back to this fraught Northern Hemisphere, there's some pretty ugly politics up there in a number of countries, and people are losing faith in governments. There's been a great survey by the Edelman Foundation, quite highly respected, and they look at people's faith in government, in institutions, charities, corporations. And while it's quite fun to look at the league table as to see which governments have the least credibility, and actually at the moment it's Japan that's at the bottom of the table, so you can look at it and see where you are in the league tables. The real message is that no OECD government does more than 50% of the population have faith in the government. And if they don't have faith in the government, they're not going to have faith in the money that government is providing. So if those governments with a lack of credibility throw more money at the problem, I think you're inviting inflation expectations to pick up. And that could be what unsettles markets next year. So I'm looking at enjoying the rally in the near term, but it's probably one where you have to think about what comes next, rather than sitting passively and enjoying it.
So what does come next? I guess, European governments throwing money willy-nilly. Is there another sovereign debt flare-up in Europe off the back of all this?
I think there would be if the European Central Bank was going to focus on inflation. And there are pockets of inflation. I'm actually very positive on the outlook for Spanish growth. It's a very competitive economy with a very strong balance of payments and a fixed exchange rate regime that normally gives you inflation. And look, you've got credit growth accelerating, house prices taking off in Spain. And it's an often joke, you can always tell which European country is doing well because everybody starts drinking their beer, it becomes trendy. And I can assure you, London is now awash with Spanish beer. It's one of those weird indicators that shouldn't but does work. So the ECB, I think, will be blind to that. It's not going to care about Spanish inflation. It's going to care about the French government deficit, and ultimately Italy's as well, and ensuring that Germany can rebuild its military, and all of those things I think will take precedence. So I don't think we get the sovereign flare-up in Europe. I think the ECB papers over that with money printing, but at the cost of inflation. Could get a sovereign flare-up in the UK. I'm actually very worried about sterling. The UK fiscal accounts are in a pretty sorry state. The government has no credibility, may not even be able to pass a budget in November, which could cause a general election and a lot of uncertainty. So I'm quite nervous about sort of gilts, and more particularly sterling in the sovereign space in Europe. But the European Union, the Eurozone, I think, the ECB just ensures that at the cost of inflation. And probably we're going to see that in Japan. We've got a new prime minister promising to spend money. I'm sure the Bank of Japan will be bullied back into yield curve control. The Ministry of Finance in Japan can't afford 2% 10-year yields. The fiscal mass just doesn't work. In fact, one of the few countries at the moment that is probably sustainable in terms of its level of nominal growth and its level of yields is China, where they are implicitly monetizing about $250 billion worth of government debt per month. That's quite a big quantitative easing. And in the near term, that's stabilized China's economy. But again, you've got to worry, does that ultimately lead China into a more inflationary path? The population is already showing that they don't like holding more bank deposits. The banks struggle to hold on deposits nowadays. That's why China has such large capital outflows. People would rather hold cash than deposits. If the government prints a whole load of more money into a system that's already sort of losing faith with deposits as a store of value, China could even flip-flop into inflation on a 3-5 year view in this world. So
is that temporary, or is that like a structural shift in their economic model?
They've been bouncing between doing this closet quantitative easing and not doing it for about the last 18 months. They sort of do it for 2 or 3 months, the equity market would pick up, the economy would stabilize, then they'd take their foot off the accelerator and things would fizzle out again, and then they'd have to do it again. And I think the reason they didn't do it on a sustained basis was they are worried about inflation. If you think of the Chinese Communist Party, what's been the only existential threat that they've faced in the last 40 years was the inflation that culminated in Tiananmen Square. I know a lot of people talk about all sorts of things that might have been driving those protests in the late 80s. As somebody that was visiting China at that time, my impression was it was actually just the middle classes were being squeezed by inflation and they were unhappy about it. And I think it's perhaps a modern rewriting of history to say they were protesting for democracy. I think it was more basic than that it was just living standards were being squeezed. So I think that the Communist Party in China is very attuned to the threat that inflation would pose to them. And that's why they've been doing these spasms of quantitative easing and then pulling back again. But with the effect of tariffs, a global trade slowdown, the domestic credit crunch and the private sector getting worse because of the problems in the banking system, the Chinese corporate sector is now struggling to finance its cash flow deficit because the banks are so weak. I think these injections of liquidity are becoming more regular and larger. So yeah, it's not a structural change, but I think it's an evolution that they were giving themselves a few painkillers over the last 18 months, but now they're popping those pills pretty much every day, to use a fairly tasteless analogy. And that does raise the threat of monetary instability. And I think it's a story that people don't seem to think about and don't talk about. But that China is bleeding $1.5 trillion a year in capital outflows because domestic savers want to diversify into other assets out of Chinese assets. Yeah, it's inflationary for the US, it's inflationary for property markets, and I think Australia's had more than its fair share of those flows, certainly New Zealand as well. You look at some of the flows in the balance of payments and they're now large relative to the recipient country's GDP. But I think that tells you that there is an underlying financial fragility in China, and if they do too much quantitative easing, people could start dumping money and start trying to find alternative stores of value. And that tends to be things. It's unlikely to be property, given what's going on in the property market. It could start to be consumer goods. I mean, I mentioned before around Tiananmen Square and the inflation of the late 80s, early 90s in China. And I remember garlic becoming a store of value. People were literally hoarding garlic, and things like this are in the consumer price index. So that does become inflationary.
Okay, Andrew, so we've covered China, we've covered Europe, we've covered the US, Japan. What else can we expect for the rest of 2025? What will you be telling us probably when we have our next quarterly update at the start of next year?
I mean, I think the thing we've absolutely got to get right in the next call is whether the easing that we anticipate over the next few weeks, which is sort of beginning, and I say it started in China, it started in Europe. I think we're on the cusp of it in Japan. The Fed's done one rate cut, and there's more to come. And if the banks do take at least some of the bait, we will get a wave of liquidity. But I think our next call has got to be to decide whether that liquidity wave has turned out to be inflationary. I think we've got to look at things like capacity utilization, as I keep mentioning, inflation expectations, any proxy we can find for any leading indicator for inflation. I think we've really got to be on top of, because if those are deteriorating, then this liquidity is an opportunity to divest from the things that have driven markets for the last few years, that concentrated AI theme, and start looking at, let's say, towards value, and also to think about the private markets. I mean, private equity, I guess, is struggling a bit already. It is harder for these guys to get their NAV loans, and disposing of assets is proving harder. But I think we might be seeing the first cracks in private credit. And at the moment, it's a bit like the mortgage market in spring 2006. You're starting to see the math doesn't work, but people are trying to ignore that. Where I think private credit as an industry, and certainly there are good private credit funds as much as there was good mortgage exposure back in the day, is these guys are, as I've mentioned, very leveraged. And the way in which they borrow is through the collateralized short-term money markets. So they're pledging bonds as collateral to borrow money to gear their portfolios. If we see bond markets stop rallying and maybe start to sell off a little bit as inflation expectations start to rise next year. That means these guys have less collateral to pledge. They can borrow less. They can't grow their balance sheets. Plus, if you've got that sort of inflation, sluggish growth, a few things will be going wrong inside the portfolios, and maybe sentiment towards the industry will be souring, particularly if we see more of these questions about accounting. And I think that will be one hugely important to the stocks themselves or that part of the market. But let's not forget that even the likes of Meta and OpenAI, their big AI spends, the trillions of dollars they're promising to spend, have a heavy funding component from private credit. Altman talking about his new financial instrument, which basically is some form of private credit, I suspect. Meta, when they announced their big spending program, announced which private credit entities were going to be funding them. So if you see problems in private credit, which is now the biggest single source of external financing for the US corporate sector, if that industry starts to suffer as perhaps market sentiment changes and evolves more towards an inflation bias, then I think the AI boom will fade. And that's another reason to think that perhaps there's a big rejig of portfolios. And I think if we time our next call right, we should be in the center of that period where you're starting to get the answers to those questions.
Well, Andrew, we look forward to the next call then, and we'll have to compare notes with this one. Thanks again for joining us and for imparting your latest update.
It's a pleasure. So I've written a lot of this stuff up in some of the recent reports, and I think this week's weekly has quite a lot of detail on this, how the foreign sector is now almost single-handedly holding up markets, and whether there can be whether the domestic sector can take over the running again, because I think that's a fairly important question at the moment. And then, as I say, longer term, we've got to get this call on inflation in 2026 right.
Excellent. We'll make sure that we make that report available to people that want it. Enjoy the rest of your time back in New Zealand, and we'll check in again very soon.
Great. Thanks for hosting. Talk to you soon.